Hello and welcome back to Heart of Economy. Today we're diving deep into a critical topic for gold investors: how Trump's potential second-term policies could impact gold. Goldman Sachs updated forecasts and what top economists are saying about the path ahead. This video is not financial advice. As of the end of June 2025, gold is trading between $3,330 and $3,335 per ounce. The US dollar index remains around 104, while annual US inflation is steady at 3.1%. Global markets are closely watching the Federal Reserve's interest rate path and the uncertainties tied to the upcoming US elections. Ongoing gold purchases by China and other central banks, rising geopolitical tensions, and persistent inflation expectations continue to provide a supportive backdrop for gold. In its recent report to institutional clients, Goldman Sachs highlighted that gold may temporarily pull back to the 3,262-3,300 range due to CTA-driven selling and market volatility, while maintaining its long-term bullish outlook. Why a near-term pullback is expected? Technical selling from CTAs and algorithmic funds. Uncertainty around the Fed's rate cut timing. Investors reducing positions ahead of the election cycle. Potential short-term dollar strength. Or all factors creating short-term downside pressure on gold. Goldman Sachs emphasizes these pullbacks are temporary and do not disrupt the long-term upward trend for gold. Goldman Sachs maintains its target for gold to reach $3,700 per ounce by the end of 2025 and $4,000 per ounce by mid-2026. Key drivers include ongoing purchases by China and other central banks, rising geopolitical tensions, the risk of a weaker US dollar over time, persistent inflation, increased institutional demand through gold-backed ETFs. Goldman Sachs views these potential pullbacks as healthy corrections, offering long-term buying opportunities for investors. Trump's potential second-term policies could impact gold across four key pillars: interest rate policy, dollar strategy, fiscal spending, and trade policies. Interest rates and pressure on the Fed. Trump has repeatedly argued that high interest rates are slowing the US economy and keeping the dollar too strong, hurting exports. If re-elected, he may push the Fed to cut rates or even consider leadership changes at the Fed. Such expectations could increase the risk of a weaker dollar and support gold prices. Rate cuts in an inflationary environment could push real yields closer to negative territory, further boosting gold's appeal. Trump may pursue a controlled weakening of the dollar to boost US exports. A declining dollar could prompt central banks to increase their gold holdings not only for diversification, but also as a hedge against Trump's plans for infrastructure spending, boosting domestic production, and tax cuts will likely increase government spending, widening the budget deficit and potentially making inflationary pressures more persistent. Trump's potential protectionist trade policies and renewed tensions with China could increase global uncertainty, driving investors toward gold for stability. The combination of central bank buying and economic uncertainty under Trump's policies could help gold remain strong in the medium and long term. Trump's potential combination of lower interest rates, higher fiscal spending, a weaker dollar, and increased trade tensions could create a supportive macro environment for gold over the long term. While CTA-driven selling may cause short-term volatility, the longer-term upside potential for gold remains intact. Insights from top economists. Peter Schiff's view. Peter Schiff expects that under a second Trump term, there will be pressure on the Fed to cut rates. Money supply will expand. The dollar will lose value. Inflation will accelerate. This environment, he argues, would position gold as both an inflation hedge and a safe haven asset. Schiff emphasizes that gold is not just a crisis hedge but a store of value during periods of monetary expansion. Mohamed El-Erian's view. Mohamed El-Erian warns that Trump's push for lower rates and expansionary fiscal policies could expose the U.S. to stagflation risks. A mix of low growth, high inflation, and rising unemployment, which historically drives investors toward real assets like gold. El-Erian highlights that persistent inflation, dollar weakness, and geopolitical tensions would likely increase both institutional and retail demand for gold. He underscores that gold plays a critical role not just during crises but also in environments with persistent inflation and macroeconomic fractures. Schiff and El-Erian's insights illustrate the multifaceted impact Trump's potential policies could have on gold. However, it's vital to view this analysis in the broader context of investor psychology, central banks' reserve strategies, and global capital flows. Trump's push for lower interest rates and expansionary fiscal policies may initially fuel risk-on sentiment in markets, but persistent inflation could quickly put investor behavior back towards safes like gold. A weakening dollar could lead central banks to not only diversify but also actively seek alternatives to the dollar's reserve status, increasing gold demand in the process. Short-term CTA-driven sell-offs may create temporary pullbacks in gold prices, but for long-term investors, these could present valuable entry opportunities. At Heartofeconomy, we believe that Trump's potential policy mix, lower rates, higher spending, a weaker dollar, and protectionist trade measures could establish a strong macro foundation for gold over the medium to long term. Gold is likely to remain an essential hedge against inflation and economic uncertainty. Remember, the long-term trajectory of gold will continue to be shaped by Fed policy, inflation trends, central bank purchases, the dollar's global role, and evolving geopolitical dynamics. This analysis is not financial advice and aims to help you approach gold with a broader, informed perspective. If you found this analysis valuable, subscribe to Heartofeconomy and turn on notifications to stay informed on the latest deep dive financial insights. See you on the next analysis. Take care of yourself and your investments.